Hello and welcome back to Chart Pattern Trading Masterclass and from Wealthy Education. As you can see, I've got the chart up, but this is going to be a little bit different video in the sense that it is about psychology. You need to understand that psychology is really what a chart shows. So, for example, I've got this daily chart of Ethereum here, and it could be anything, it doesn't matter. And I'll even simplify it. I'll bring it down to a line chart. So what you're seeing here is how people feel or think about Ethereum. You're seeing major spikes higher, major spikes lower, depending on fear and greed. If people think that an asset is going to go to the moon, or whatever expression they want to use at that moment, they will buy it. You can see that was clearly what was going on here. This was greed. Also, you have to understand that moves like this don't really happen very often. And when they do, they always pull back because sooner or later you run out of people to buy the asset. So you need to look at it through the prism of, can it really continue this type of momentum? That's a lot of greed and that's a big sell off. That sell off is partial taking profits. It is partially fear driven. I mean, imagine that you got in and you gained $1,000 per coin in like a week. Well, that's a huge move percentage wise. That's almost doubling at this point, and that's something that can't last. So those are your movers of the chart. So I've got dollar Swiss. Let me get rid of this support and resistance lines that I had drawn previously, and let's go to the weekly chart, and you can see big greed, big fear. Now you need to understand that most of what you will be fighting in the markets, stock markets, um, crypto, futures, currency, or anything else, honestly, your biggest fight is going to be with yourself. So, here's the famous AMC trade. That was greed. That was insanity. Go ahead and go to the daily. I mean, that's not a normal move. That, and in a sense, that was fear because part of what was going on was people who had shorted the market, in other words, bet on the thing going down for so long, suddenly found themselves in what is known as a short squeeze. And a short squeeze is the market, um, all the short sellers having to buy it back. So on one side of the aisle, you had greed, on the other, you had fear. And that's a perfect example of how markets behave, because you had all of those people that were sure the market had to buy it back, and all of those people that were greedy at the same time jumping in. And you can see everybody's lost money since then. That got long in AMC that didn't get out and take their profit. So that brings me to the next point. You need to understand that you need certain rules. You don't just buy because something is going higher. There are people that thought this was going to go to I don't know, infinity, and there were people out there buying and they lost a lot of money. So what you want to do is set up like a technical trading system like we're going through in this class. You decide that, you might have one play that you like. Maybe you like it when rectangles are broken out of, whatever. And you stick with that and you stick with that one particular play. That will keep you from over trading. So what you're looking for is a setup of a specific type, and that's all you trade for a minute. And then you add and you keep adding on. And then eventually Maybe you have 5 different setups that you're willing to take. And you have to be aware of the fact that not every day is going to offer their particular setup, and you have to be okay. And that's one way that you can overcome greed and overtrading. Another thing to overcome greed is a lot of times when you are in a big move. So, say you were in this big AMC move, somewhere along the line, you have to set stop loss orders. You should have one going in, but if you have seen this type of move, you have to decide that somewhere you're willing to get out and take profit. Even if it was just something ridiculous like all the way up here, that's a ridiculous move in a stock. That is a massive gain. So when you're up here, you have to say, okay, I'll give it like a third back. And if it gets back over a third, then I'm just going to take my profit. You would have done quite well. So that's one thing that you need to understand about overcoming greed. And you don't move your stop losses. If you set a take profit order, you should follow it. Although in an explosive move like this, let's just say you got in and you thought you were going to go to here, right? But you happen to see the momentum really picking up and it's really taking off. Some traders would take like half of their position off and then move to their stop loss to break even and just kind of see how lucky they get, right? Sooner or later, though, you still have the same issue. Where do you take your profit? You have to figure out on the way up, or just say, okay, it's blown through the ceiling here. Where am I comfortable taking profit? At the very least, you don't lose money. Now, there are a multitude of ways to improve your trading psychology. And this is one that I've used for years with any new system, any new market, as I have jumped from market to market, is get yourself comfortable enough to leave the trading platform. So let's just say you're trading euro yen and you see this setup and for whatever reason you believe that this is the top and we're going to start selling off, or in this case I would be more apt to buy the pullback because it's with the overall trend. So let's just say you buy it right here. Now it happens to be the weekend as I'm recording this, so price isn't moving, and you decide that your stop loss is 141 and a half. What you will notice is, depending on the size, you may or may not feel the need to watch the market the entire time. So you can start with, I'm just throwing numbers out here. It's going to be different for each account and for each person, but let's just say you start with something like $1 a pip and you're risking maybe 150 to pick up 400. Now that might be perfectly comfortable for you. And then if that's the case, if you go on about your day, you don't find yourself worrying about it or checking the platform every 10 minutes or whatever, maybe move up to 120, $1.20 a pip. Conversely, if you find yourself still a little bit nervous about it, bring it down to 50 cents a pip. You will notice the psychology changes quite drastically. You may find um, that and most of the time you'll figure this out percentage wise, right? But I'm just using this as an example. You may also find that perhaps um go ahead and remove the draw link. You may find that this is a situation where you are comfortable with 0.5% risk. You may find that you are very uncomfortable with 75 basis points or 0.75% risk between your entry and your stop loss. So I think one thing that people get very far away from is that when we go into trading to make a living. We trade to live, not live to trade. So my best advice and the best thing that I've ever done for myself has been kind of going back and forth with this. Other people of a different type of mentality altogether might be comfortable with 3%. Now, professional managers would never do that, but because the math doesn't work out in your favor of the long term. But having said that, it's going to come down to your individual psychology. I know some traders who only risk a tenth of a percent every trade. Now, a lot of times those guys will not have a target. So they'll risk a tenth of a percent, but they may be in this trade for 6 months because it blows past the target. Next thing you know, they've made like 5% on that trade. So a lot of it's going to come down to how you look at the markets and what you are comfortable with. There is no one size fits all. You should risk X amount of percentage. I know a lot of people say 1% and 2%, but the reality is you don't even need to risk that much if you are willing to hang on to gains. And most professional traders don't. So it's an experiment. You need to decide, hey, am I comfortable with $1 a pip, or do I need to think of it more along the lines of 0.25% of my account? And if you are comfortable, then maybe bump it up just a bit. Next time, instead of 0.25%, maybe make it 1/3 of a percent, 0.33. If you're not comfortable there, then somewhere in the middle of that is going to be your comfort zone where you're not worried about it. Because the biggest problem you're going to have is if you are not comfortable, you're going to do something to mess up the trade more likely than not. You'll jump out too early. Um, you know, you'll take losses that could have ended up being gains, that type of thing. The idea is you jump in the market and you have the ability to not worry about it. You just let the market do its thing. And from years of experience, I can tell you this exercise with position sizing, be it percentage or pip wise, is one of the smartest things I've actually done for myself. So, in the next video, we'll start talking about mastering risk and money management, which we kind of touched on in this conversation. So, we're just going to expand on that.